In 2025, for the first time in over half a century, the person calling the shots at Berkshire Hathaway wasn't Warren Buffett. So today, we are cracking open the company's first annual report of this new era to figure out what it tells us about the future of this absolute financial empire. So let's just start with a number. What kind of company makes nearly $67 billion in profit in a single year? I mean, that's the mind-blowing net earnings that went to Berkshire shareholders for 2025. It really sets the stage for what we're about to talk about.
And then there's this number. That same company, after that incredible year, ended up with $369 billion sitting in cash and short-term treasuries. Look, that's not just a rainy day fund. It's a mountain of capital larger than the entire economy of many countries.
But here is the thing that changes everything. For the first time, the person making the final call on how to use all this money was not Warren Buffett. It was his successor, Greg Abel. So, what do these massive numbers tell us about where he's steering the ship?
Okay, let's dive right into Berkshire's balance sheet because you really have to grasp the sheer scale of the empire Abel is now in charge of.
Try not to get lost in all the line items here. The big picture is what matters. Berkshire isn't just a holding company, you know? It's a colossal financial engine. Its operations stretch from insurance and railroads all the way to energy and retail, and it pulled in over $371 billion in total revenue. Just massive.
And that brings us to the most important question, right? How is Greg Abel actually deciding to spend money inside this empire? Well, when you start analyzing the 2025 report, a pretty clear new doctrine starts to take shape.
So, based on some fantastic analysis from HDIN Research, Abel's strategy seems to rest on four core pillars. You can see he's clearly blending Buffett's famous discipline with his own, deep industrial focus. Let's break these down.
First off, he is absolutely sticking to strict financial discipline, a rule he got straight from Buffett. This means any share buybacks have to actually add value. Basically, the stock has to be on sale. And the company must always keep a giant safety net of at least $30 billion in cash. No exceptions.
Now, here's where it gets really interesting. Seeing where the new money is actually going. This table shows us the earnings from Berkshire's main operating businesses. Sure, the insurance side is the financial heart of the whole thing, but look at the industrial parts. The railroad, the energy company, manufacturing. They are just incredibly powerful profit centers.
And this chart really tells the story. The BNSF Railroad and Berkshire Hathaway Energy, just those two, generated over $9.4 billion in net earnings. Abel's doubling down here, pouring money back into these hard-to-replicate, cash-gushing industrial assets.
This shows a subtle but, I think, a really significant pivot. While Buffett was famous for buying huge chunks of public companies like Apple, Abel seems much more focused on buying and building the industrial core of Berkshire itself.
Which brings us to the biggest challenge Greg Abel is facing: navigating the $369 billion question. What's the game plan for this unprecedented pile of cash?
I mean, seriously, this isn't just an accounting entry. It's the central strategic problem for Berkshire Hathaway. Figuring out how to use it effectively without overpaying for things in a hot market, that is a massive, massive challenge.
If you peek inside the insurance portfolio, which is really the financial engine of the company, you can see a deeply conservative, cash-heavy stance. A full 40% of the insurance group's assets are just sitting in cash or short-term T-bills. That just screams extreme caution and, frankly, a lot of patience. So what is he not doing with all that cash? Well, he's totally resisting the market pressure to just buy back a ton of Berkshire stock. The fact that not a single share was repurchased in the fourth quarter tells you everything. It's a clear signal that he felt the price was just too high.
So what is he doing? He's making very targeted strikes. The $9.5 billion deal to buy Occidental's chemical business, OxyChem, is a classic Abel doctrine move. He's buying a whole industrial asset that's a consistent cash-generating earner.
So what does this all mean for the future of Berkshire and for its shareholders? Well, an independent analysis from HDIN Research really shines a light on both the strengths and the potential risks of this new strategy.
The main challenge that HDIN Research points out is that being extremely safe, well, it comes at a cost. While parking over $321 billion in super-safe, low-yield treasury bills protects the company, over the long haul, it could actually drag down the return on equity for shareholders. And, it's not just about the cash pile. The fortress is facing other pressures, too.
We're talking about major litigation risks tied to the energy business, big write-downs on older investments like Kraft Heinz, and just the sheer complexity of managing $120 billion in insurance reserves.
And this really leaves us with the ultimate question about this whole post-Buffett era. Is Greg Abel building a more focused, industrial-heavy growth machine, or is he battening down the hatches on a financial fortress because he sees a major economic storm on the horizon? The answer is going to define the next chapter for Berkshire Hathaway.
To dig into all the data behind this analysis, you can find the complete report from HDIN Research right on their website. Thanks so much for watching.